We're joined today by Mark Lopresti. He's the Senior Market Strategist and CEO of Market Rebellion. Also joining us is Richard Stern. He's the Director of the Thomas A. Rowe Institute for Economic Policy Studies and Director of the Grover M. Herman Center for the Federal Budget. Good morning, gents.
Good morning, John. Good morning, Krista.
I want to start with your reaction to Warren Buffett's latest move. $382 billion in cash is a lot of money. What do you think he'll actually end up doing next with all of that cash? Let's start with you, Mark.
Well, listen, first of all, it's a bad bet to bet anything against the Oracle of Omaha. And what he does with Berkshire Hathaway is not necessarily what the rest of us should be doing in terms of investing. He's got a very, very unique, very specific strategy. I think he's going to make some additional investments in some of the key areas that Berkshire has been so famous for in the insurance sector and other places. One thing he's not going to do is he's not going to do a stock buyback. That was one of the things that he was very clear about in the notes that accompanied this release. He does not think that the stock price is at an appropriate level to conduct a buyback right now, doesn't think it's going to be a wise investment for the shareholders. That coming as a little bit of a surprise to Wall Street. But what this portends for the rest of the economy, listen, guys, smart investors, when they think it's a good opportunity, they put money, they get their cash hoard ready to do some buying. So I actually think that it could be a pretty additional bullish catalyst.
Richard, contrast Warren Buffett's style of investing. Many view him as a value investor to what we're seeing right now with the markets. People are calling it overvalued. We are seeing a sell-off in pre-market trading this morning, saying that the tech industry, AI, the valuations are out of whack here. So can you talk more about this and compare it to Warren Buffett?
Yeah, so I think the interesting question here is exactly how much AI will bear fruit, right? We all know that a lot of what's going on right now, a lot of the growth is coming from the anticipation of massive productivity gains across the entire economy from AI and from things related to that. But, you know, there's also uncertainty because of the tariffs, because of the trade framework negotiations. And of course, we all expect a lot of economic growth from Trump's deregulation, from the new tax cuts, from the stuff he's done to bring more energy into the market. So I think one way to look at what Buffett's looking at is that he knows that it takes time for the deregulation and tax cuts to work their way into the market, that there's going to be a moment here where the uncertainty ends around the tariffs, and we're going to have some more clarity on AI. So I think he might be thinking that you might have a little bit of a sell-off in between, a lot of investors waiting in the sidelines. He's literally one of them. And my guess is he's waiting to pounce the minute we've got that kind of clarity. So that's the way I'm taking it.
Interesting.
He also considers, regulation, right? One of the things that can actually help or hurt not only the macro but micro environments for various industries. And with that said, the Supreme Court is hearing arguments this week on whether President Trump's use of emergency powers to impose tariffs is constitutional. What's the immediate economic impact if the court rules against Trump? Because many people say that in absence of tariffs, we might actually get back to what they deem normal, but President Trump has a different strategy on how to rebuild the economy going forward. What do you say, Mark?
Well, first of all, let's be very clear, guys. You only need to look at how the market's doing, notwithstanding this morning's little sell-off in tech and small caps. You only need to look at how Q3 earnings reports have been coming in. You only need to look at how strong this economy continues to be going into the end of the year to understand, regardless of whether you love him or hate him, that President Trump's tariff policies and his aggressive posture towards restoring American dominance on the global trade picture is working, okay? And here's the bottom line to your precise question. Even if the court should come back and say that one or more pieces of legislation or one or more pieces of a bill that the president relied upon for imposing the tariffs that he did, whether it's the International Economic Emergency Powers Act or one of the other pieces of legislation that have been relied upon thus far for his tariff policy, gotta remember something, guys. They are not the only arrow in the president's quiver. There are a whole host of other pieces of legislation, of other authority that President Trump can rely upon should the court determine that his use of the International Emergency Economic Powers Act was unconstitutional. I'm not so sure, by the way, that I'm ready to assume that that's going to be this ruling.
Yeah, because President Trump has made such a great case as well for national security and how the tariffs, we are at a point where the tariffs are influencing that, with fentanyl crossing our borders, with tariffs being used to negotiate with China, with Russia, and the like. So I tend to agree with you, Mark, on that point for sure. But now taking a look at the housing market, Scott Bessent is sounding the alarm about parts of the economy, pointing to housing as a weak spot and blaming high mortgage rates for a slowdown.
I think that we are in good shape, but I think that there are sectors of the economy that are in recession, and the Fed has caused a lot of distributional problems with their policies. We've seen the biggest hindrance for housing here that are mortgage rates. So, if the Fed brings down mortgage rates, then they can end this housing recession. Low-end consumers who have gotten killed under President Biden, these high rates are hurting them because they have debt, not assets.
Richard, what's your take on Secretary Bessent and what he is explaining with respect to mortgage rates coming down and how that affects our quote-unquote housing recession?
I think he's right. So, we all know that there's a trade-off between inflation and interest rates, and that for the Fed to try to keep interest rates low, you risk inflation, and to keep inflation low, you keep interest rates high. And so the way I liken it is it's like a fever, right? If you keep interest rates high, you can burn off inflation, but just like a fever, sometimes you can kill the patient. So we all know with high interest rates, you have a lock-in effect. People are trapped in the homes they bought years ago, that people can't get new cars, that it means that you have no new financing to come in to help home builders build new homes. And so the truth is, inflation is still a little elevated, but we've been doing this for so many years with very high interest rates that we were starting to kill the patient while making no additional progress on the fever of inflation. So I think, look, what the Fed's finally come around to, what Bessent's been pushing for a while now, is that we can tolerate slightly elevated inflation. We need to get the rates down so that you get out of that lock-in effect. And that's what's been starting to happen, but it might be a little too late to make sure that the sector continues.
Interesting that you mentioned too late. Now, the Federal Reserve officials remain divided on whether another rate cut is coming in December. San Francisco Fed President Mary Daly said that this week she'd keep an open mind after backing last week's quarter-point cut. Given the ongoing uncertainty in the job market and the government shutdown still at play, Mark, how might another rate cut impact the American people with regard to what Scott Bessent just mentioned in terms of the housing recession and so many other things as we actually start looking into the first quarter of 2026 with the hopes of finishing this year very strong?
Yeah, listen, first of all, it's troubling to hear any of these Fed governors put forth what I consider to be a remarkably tone-deaf approach to question whether or not we should be putting forth another 25 basis point rate cut at the Fed's last meeting this year. It is, as President Trump likes to lovingly refer to Chairman Powell, too late, Jay Powell. He changed economic policy too late. He started the most aggressive pace of rate increases in the history of the American economy, and it's a genie back in the bottle kind of a situation. I love Richard's, by the way, the fever and the patient. I'm going to take the genie in the bottle analogy just to keep those morning analogies going. It's one that you can't put the horse back in the barn, right? Once you're too late, you're causing economic damage. We've seen the economic damage as a result of this Fed's failed monetary policies and the real estate crisis, and we really do have we have an affordability crisis. We have an availability crisis going on right now that's not going to be materially impacted or improved in any way until rates come down. So if these folks on the left want to think about, inflation, maybe the economy, the stock market's too high, which is not their job to be commenting on the stock market, let's wait and hold off on bringing those rates down. They're hurting the very people that they claim to serve that are at the most at risk when it comes to the housing crisis and the affordability crisis that we have. We've got to get rates down, and we got to get them down now.
Absolutely. And the thing is, Powell is being called too late, which means that he has to catch up, but they're slow walking the rate cuts, to your point.
Mark Lopresti, Richard Stern, thank you both for joining us this morning.